Now, if you tuned in yesterday, you would know that for the next 2 weeks, we're going to shake it up a bit from our usual stock of the day. I've asked our guests to pick a stock that they would buy today to help fund their kids' or grandkids' education costs. Think of it as sort of almost like a future fund. I'm looking for the long-term, high-quality portfolio to pay for horrendous education costs that children face, or raising kids. I've got my own children with their own kids asking me to put in money. I'm saying, no, stuff that. I'll talk to our experts about some stocks that you put away to pay for education costs. So let's see what our expert panel thinks today. Scott Phillips, it's an interesting one. You must get this from your cohort a fair bit on how do you invest and put away a little bit to pay for kids. What's a stock you'd suggest?
Yeah, Koshi, I've gone a little bit boring by choosing an ETF, mate, but I hopefully made up for it with the excitement of the companies that you're in, and that's the Betashares NASDAQ 100 ETF. It trades on the ASX under the code NDQ. A couple of things there. The first is these are the companies that I think are going to keep inventing the future, both the companies that already are on the index and the ones that are going to be added to it over the next 5, 10, 15, 20 years, depending on how long you're saving and what you're paying for. These are the businesses that are literally inventing the future, mate. It sounds like an easy marketing tagline. Maybe it is. But think about the Apples, the Amazons, the Facebooks, the Netflixes, the Nvidias who are doing the graphics processing unit chips, the Teslas, and then whatever the next generation, the generation thereafter are, I think they'll most likely be listed on the NASDAQ. So the tech titans of today and tomorrow, I think, are there. It's going to be a good ETF, so it's diversified. So it means if you're going to go only buy one or a couple of these, you get a nice chance. The other thing is, of course, these are companies that hopefully those kids themselves can identify with. So if you're sharing that information with the kids, saying, here's what I'm doing, you talk to them about companies they own, they use, they encounter, they're part of every day, week, month. They also get some sense of what, why, and how. You might just build some love of investing alongside actually paying for that education cost as well.
Yep, great suggestion. Great suggestion. Mark, what would you suggest?
Well, it's a challenging one, and I put all my kids through private school and wore the cost and the agony of that, and swore that I would never pay for my grandchildren. And of course, what do you think's happened?
You're a sucker.
I'm paying half.
Right.
Which is why I'm going to have to keep working until I'm old age. So this is a really big problem, and of course, depending on how many years you're talking about, I think Scott's suggestion is a good one, but I couldn't suggest an ETF because we don't do ETFs. So I thought, well, out of our wealth winners, which is the best, least, or the lowest risk, highest return company over the long term, and I've chosen TechnologyOne, TNE.
Oh yeah.
And it's a company I've spoken about lots of times, and I went back and had a look at it. I first invested in this company 10 years ago, and my average compound return is 94% a year. Over the last just over 10 years, nearly 11 years. So now at the moment it's not cheap right at the moment though. It's $11.89. So I didn't work on the basis if you'd buy it today. I would say this is a perfect company because it's got fabulous moats, founder CEO, very, very strong business model that I can't see being disrupted over the period. But I wouldn't pay more than about $8.50 for it. It's currently $11.89. But that, by the way, if you look at the history of it, I would say you will get an opportunity to buy it at that kind of price within probably 6 months or 12 months, because that's the fluctuation. It's right at the top of its range at the moment. Yep. So obviously, the better you buy these companies, the better you do from a compound return point of view. But that's a company you could also add to over time, and it doesn't meet the diversification argument, but it's super low risk. I think it's one of the lowest risk companies on the ASX, and I think if you buy it at $8.50, you would get about 20% per year return. And 20% for viewers, if you get 20% average total return, that's 6 times your capital. So if you put 10,000 in, you have 60,000. You put $1 million in, and you have 6 million in 10 years. That just puts it in context. So
that's a really good suggestion.
And
a good stock to put on your list for a pullback in the market if you're one of those people a bit like me that get a bit scared about September and October. That if there's a crash, you put it on your list to get into it at a much cheaper price.